Central banks don't buy gold when they trust their own currencies. In January 1931, the Bank of England held the largest gold reserves in Europe, over 4,000 tons of the metal that had backed British currency for centuries. But something unusual was happening in the vaults beneath Threadneedle Street. Gold was disappearing, not through theft or accounting error, through systematic withdrawal by foreign central banks who had lost confidence in sterling's stability. The Bank of England faced a choice that every monetary authority eventually confronts: honor gold convertibility and watch their reserves drain to zero, or abandon the promise that had made their currency trusted worldwide. They chose abandonment. On September 21, 1931, Britain left the gold standard permanently, devaluing the pound by 30% overnight. The currency that had been the backbone of global commerce for over a century became just another government promise backed by nothing but political will. What happened next reveals a pattern that's repeating today with frightening precision. Central banks around the world, witnessing Britain's monetary collapse, began accumulating gold at unprecedented rates. Not because they planned to return to gold backing, because they had learned that promises could be broken, currencies could be abandoned, and only tangible assets survived monetary catastrophes. Today, central banks are buying gold like it was 1931, record purchases, unprecedented accumulation, desperate hoarding by the very institutions that spent decades telling us gold was a barbarous relic. The pattern isn't coincidence, it's preparation. They're preparing for the same monetary reset that destroyed confidence in sterling 90 years ago. The gold standard collapse of 1931 wasn't sudden. It was the culmination of a decade-long process that began with World War I financing. Britain had suspended gold convertibility during the war, promising to restore it once hostilities ended. They kept that promise in 1925, returning to gold at the pre-war parity of $4.86 per pound. But the Britain of 1925 wasn't the Britain of 1914. War debts had accumulated, industrial capacity had declined, trade balances had deteriorated. Maintaining the gold standard at pre-war parity required interest rates high enough to attract foreign capital. High interest rates meant domestic deflation. Deflation meant unemployment, business failures, social unrest. The Bank of England found itself trapped between external monetary credibility and internal economic stability. They chose credibility, implementing policies that devastated the domestic economy while preserving international confidence in sterling. This arrangement worked temporarily. Foreign investors continued holding sterling reserves. International trade continued using pounds for settlement. London remained the center of global finance, but beneath the surface, mathematical forces were building pressure that no monetary authority could contain indefinitely. Britain was running persistent trade deficits. They were importing more than they exported, paying the difference with gold outflows. Each deficit had to be financed through either borrowing or gold shipments to foreign creditors. The gold standard made this arithmetic unavoidable. Under fixed exchange rates, trade imbalances automatically translated into gold movements. French monetary authorities understood this dynamic perfectly. They began systematically converting sterling holdings into gold, not because they questioned British creditworthiness, but because they recognized mathematical inevitability. If Britain continued running deficits while maintaining gold convertibility, they would eventually run out of gold. Better to convert paper promises into metal before other creditors reached the same conclusion. The Bank of France wasn't alone. German banks, Dutch institutions, American corporations all began reducing sterling exposure and demanding gold conversion. Each withdrawal made the next withdrawal more urgent. Each gold shipment reduced Britain's capacity to honor future conversion requests. The mathematical progression was inexorable and accelerating. By 1930, Britain's gold reserves had fallen to levels that made continued convertibility questionable. Foreign exchange markets began betting against sterling's ability to maintain the fixed rate. Speculative pressure combined with fundamental outflows to create a monetary crisis that no amount of interest rate manipulation could resolve. The Bank of England tried every traditional remedy. They raised rates to punishing levels, attracting short-term capital while crushing domestic activity. They borrowed from other central banks, buying temporary relief at the cost of future obligations. They implemented exchange controls, restricting gold outflows through administrative rather than economic measures. Nothing worked because the fundamental problem wasn't technical, it was mathematical. Britain couldn't simultaneously maintain gold convertibility, run trade deficits, and preserve domestic economic stability. The trilemma of international monetary policy made one of these objectives impossible. Something had to give. On September 21, 1931, it gave. The Bank of England announced suspension of gold convertibility. Sterling immediately depreciated 30% against gold and other currencies. British exports became competitive again. Interest rates could be reduced to support domestic recovery, but the cost was enormous. International confidence in British monetary management collapsed permanently. More importantly, for global monetary stability, other central banks learned a critical lesson. Promises to maintain currency convertibility could be abandoned without warning. Fixed exchange rate commitments could be broken when politically convenient. Only gold reserves provided genuine insurance against monetary betrayal. Central bank behavior changed immediately and permanently. Institutions that had held most reserves in foreign currencies began accumulating gold. Countries that had trusted international monetary cooperation began preparing for monetary nationalism. The network effects that had made sterling useful as an international currency reversed as participants sought alternatives to reduce exposure. This is exactly what we're witnessing today. Central banks purchased over 1,000 tons of gold in 2022, another 1,000 tons in 2023. The largest accumulation since records began, not because they're planning to return to gold backing, because they've learned that fiat currency promises can be abandoned when circumstances demand. The Federal Reserve's balance sheet expansion from $800 billion in 2008 to $9 trillion today represents monetary policy extremism that makes 1931 Britain look conservative. Quantitative easing, forward guidance, yield curve control, direct government debt monetization. Every tool of modern central banking has been deployed to maintain the illusion that unlimited currency creation does not threaten purchasing power. But mathematical reality asserts itself regardless of policy innovation. When currency creation exceeds productive capacity by sufficient margins for sufficient time, confidence breaks. When confidence breaks, foreign holders begin converting paper promises into tangible assets. When conversion accelerates, monetary authorities face the same impossible choice that destroyed sterling in 1931. China understands this dynamic perfectly. They've been systematically reducing dollar reserve exposure while accumulating gold at rates that dwarf other central banks. From 600 tons in 2000 to over 2,000 tons officially today. Unofficial estimates suggest holdings could exceed 5,000 tons. They're preparing for dollar devaluation or abandonment, exactly as France prepared for sterling collapse. Russian gold accumulation accelerated dramatically after the 2014 sanctions demonstrated how dollar-denominated reserves could be weaponized instantly. They increased holdings from 500 tons to over 2,000 tons, while simultaneously developing alternative payment systems that bypass dollar settlement. The message is clear. Gold provides insurance against monetary weaponization that dollar reserves cannot provide. India, Turkey, Poland, Hungary, Singapore, Kazakhstan, Uzbekistan. Central banks across the developing and developed world are accumulating gold at unprecedented rates. This isn't a coincidence. It's coordination. not explicit coordination through formal agreements, but implicit coordination through shared recognition of dollar system vulnerability. The pattern mirrors 1930s central bank behavior with disturbing precision. Then, as now, monetary authorities publicly expressed confidence in the existing system while privately preparing for its breakdown. British officials insisted sterling was sound, while foreign central banks converted sterling holdings into gold. American officials insist dollar dominance is permanent, while foreign central banks convert dollar holdings into gold. The mathematics driving current accumulation are identical to those that drove sterling's collapse. The United States runs persistent trade deficits financed through foreign accumulation of dollar reserves. Each deficit creates claims on American assets that must eventually be honored through either real resource transfers or currency devaluation. The gold standard made this arithmetic visible and unavoidable. The fiat system makes it invisible, but equally unavoidable. Modern monetary theory attempts to argue that currency-issuing governments face no fiscal constraints. They can spend unlimited amounts because they can create unlimited currency to service any debt level. This argument ignores international dimensions that proved fatal to sterling and will prove fatal to dollar dominance. Foreign holders of dollar reserves aren't required to accept unlimited currency creation. They can convert dollars into other assets, including gold, exactly as foreign holders converted sterling into gold. When conversion accelerates beyond the Fed's willingness to accommodate, the same mathematical progression that broke sterling will break dollar credibility. The timing depends on confidence dynamics that are inherently unpredictable. Britain maintained gold convertibility for 6 years after World War I, despite fundamental imbalances. The system appeared stable until confidence broke suddenly and completely. Dollar dominance could continue for years despite current imbalances, or it could break suddenly when confidence reaches a tipping point. Central bank gold accumulation suggests we're approaching that tipping point. Record purchases indicate diminishing faith in fiat currency stability among the institutions most familiar with monetary policy mechanics. They're not buying gold because they expect price appreciation. They're buying gold because they expect currency depreciation. The acceleration of purchases provides the strongest signal. Gradual accumulation would suggest routine portfolio diversification. Urgent accumulation suggests preparation for systemic breakdown. Current purchase rates far exceed any reasonable diversification timeline. They suggest central banks are racing to acquire gold before other central banks reach the same conclusion and create supply shortages. Physical gold markets are already showing strain. Premiums for immediate delivery have increased substantially. Wait times for large purchases have extended beyond normal parameters. Fabrication capacity cannot meet institutional demand, despite price levels that should encourage supply increases. These are symptoms of a market transitioning from normal trading to hoarding behavior. The implications for currency stability are profound. If major central banks continue accumulating gold at current rates, they're signaling an expectation of monetary system breakdown within years, rather than decades. Each purchase validates the logic behind other banks' accumulation decisions. Each accumulation creates positive feedback loops that accelerate the underlying dynamic. Gold accumulation also creates operational readiness for post-dollar monetary arrangements. Central banks holding significant gold reserves can participate in gold-backed trade settlement. Banks holding only fiat reserves remain dependent on systems they don't control. The accumulation race is really a positioning race for influence in whatever system replaces dollar dominance. Historical precedent suggests the timeline for this transition. Sterling lost reserve currency status within a decade of leaving gold convertibility. Most international trade shifted to dollar settlement during the 1940s. The transition wasn't gradual. It was sudden once alternative systems achieved sufficient scale and reliability. Dollar alternatives are approaching that critical scale. China's international payment system processes hundreds of billions in annual settlements. Russian trade now flows primarily through non-dollar channels. BRICS nations are coordinating currency arrangements that bypass Western financial networks entirely. The infrastructure for post-dollar trade settlement exists and is expanding rapidly. When current central bank gold accumulation reaches critical mass, when alternative payment systems achieve sufficient reliability, and when confidence in dollar stability breaks suddenly, as confidence in sterling broke in 1931, the transition will be swift and complete. Countries won't gradually reduce dollar exposure over the years. They'll switch to alternatives immediately to avoid losses from continued dollar weakness. The Federal Reserve faces the same impossible choice that faced the Bank of England in 1931: continue policies that maintain domestic economic stability while undermining international currency credibility, or implement policies that maintain international credibility while devastating domestic economic activity. Neither choice prevents eventual loss of reserve currency status. Both choices make the eventual transition more traumatic. Central banks buying gold like it was 1931 are voting with their reserves. They're expressing through actions what they cannot express through statements. They expect the dollar system to break as sterling broke. They're preparing for a monetary reset as central banks prepared after the sterling's collapse. They're accumulating the only asset that has survived every previous monetary system breakdown. The pattern is absolute. The mathematics are identical. The timeline is accelerating. Central banks don't buy gold when they trust their own currencies. They buy gold when they've learned that currencies can't be trusted, that promises can be broken, and that only tangible assets provide genuine insurance against monetary catastrophe. They learned this lesson in 1931 when sterling collapsed despite centuries of credibility. They're applying that lesson today as dollar credibility approaches the same breaking point. The accumulation race has begun. The outcome is predetermined. Only the timing remains uncertain, and even that uncertainty decreases with each record purchase, each urgent acquisition, each desperate attempt to accumulate metal before the music stops, and everyone realizes there aren't enough chairs for all the central banks that trusted paper promises instead of golden reality.